Changes are coming. Now, I'm not going to take a deep dive into politics, and I really don't focus there, but you can be assured significant changes are coming. And what you really want to know is, how is this going to affect my money? The markets and the economy is my focus here. Some of you may get your feathers ruffled and others elated. Look, keep an open mind as I jump through historically how markets react during certain political parties holding office. Hello, Dave Douly here, a 40-year veteran of all things finance and lead advisor at Georgia Advisory Group. We're a boutique RIA firm located in Alpharetta, Georgia, composed of wealth management, tax services, and a focus on protecting assets through creative trading strategies. Now, according to the Motley Fool, since 1957, Republicans have outpaced the Democrats on market returns. Now, the difference has been slight. 10.2% for the Republican versus 9.3% on the S&P 500. Now, this is just the start. The presidency has very little impact compared to Congress on your money, and most major corporations want balance. Why? They don't like changes. Should I say drastic changes? So a particular bill must go to the House first, then to the Senate, then to the President. If the President doesn't like it, it goes back to the Senate, where a 2/3 majority must override the President. So history shows a divided Congress with a Republican president shows us a 13.7% average annual return. Not far behind is when Congress is divided and we have a Democratic president at 13.6%. So close. And finally, the third highest is a full Republican Congress and a Republican president at 12.9%. Now, the lowest returns historically have been with a Republican president and a Democratic Congress at 4.9%. Now, what does this all mean? Well, here over the last 25 years, we've had some major anomalies. Look at Clinton, who was the peak of the markets in 2000. He hands it off to Bush, and then the dot-com crash came, leaving Bush to pick up the pieces. Then you had 9/11 hit, and it just got worse. Then his second term ended with the great financial crisis. So you have a Democrat leaving a bad market to a Republican, and a Republican leaving a bad market to a Democrat, and on and on. It's just a mess. So if you had a strategy to invest more when your pick is the president, you would have underperformed by millions over the last 123 years. The best performing strategy has been to invest early in a new presidential election. That outcome has outperformed all others by a 60% margin. Meaning, if you waited a year to invest, after there was a president elected, you only had a 13% chance to do good. What's the result? Stay invested. And here's where I go back to Warren Buffett's ideology. And what he says all the time is simply this: if you can find 5 great companies in your lifetime, then buy them, hold them, and never look back. Keep it simple, stupid. Buy and hold companies you use every day. If we take the Mag 7 as a great example, just over the last 3 years, with the exception of Tesla, the political donations of these 7 companies have favored the Democrats by a 10-to-1 ratio. Now, why is that? Ideologies? Over the last 100 years, the gap from the left and the right compared to today is at a 100-year record. In other words, the split between conservative and liberal is off the charts. The common middle ground has basically disappeared. So the companies with the highest returns lean left: technology, media, semiconductors, personal and household products. The right, or more conservative investments, tend to be banks, transportation, professional service, pharma, and utilities. So is the left better? Not so fast. From 1997 to 2017, the right-leaning industries outperformed. And from 2018 through today, the left-leaning companies have had the lead, while there was a Republican president during the best run. Now, what's the conclusion politically? It doesn't matter. What matters is owning great companies with great earnings and a lot of cash on hand and great management. Now, who donates to what side has no impact. The data supports it. So Lying in bed at night or spending way too much time watching ignorant YouTube content is just a waste of your time, especially if you then react to it. I keep a crystal ball here on my desk for this exact reason. Matter of fact, let me grab it. What do you think the markets are going to do this week, Dave, or this month, since Trump is now president? I say, hey, give it a rub. It's never worked for me in 40 years. Our approach has always been owning great companies. Don't lay off risk by owning a lot of companies. Cover your positions using options when they're called for. Yes, you can lay off risk with insurance, just like you have homeowners insurance or car insurance. You can cover your portfolio with options. If your firm or advisor does not employ this strategy and just throws your dollars across every mutual fund out there, or takes on 15, 20, 30, or 50 positions, then you need to run. Yes, run. You won't believe what we see here in these offices every day as new clients come in, show us either old accounts or accounts with 500 positions. It's nuts. Then they can't figure out why they have poor returns. Had you just put your dollars in the S&P 500 or the QQQs over the last 24 months, you would have seen 48% return and 212% returns, respectively. That's right, you'd have kicked butt with no advisor. But if you want protection and you want to outperform these benchmarks, then go in and see what the prospective firm is doing. Make them show you their strategy and ask to see their personal portfolios. And most of all, reach out to several referrals that they give you who have been with them for several years. Bottom line for me is a great quote. Powerful change happens when you take control of the things you have power over, instead of craving control of the things you do not. Visit our website for additional great content and videos, and subscribe below. Till next time.